Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Thursday, June 18th, 2020, and this is the Daily Report for Gold and Silver. On today's show, I want to kind of focus on the big picture because obviously we have seen this market trade sideways for a couple of months. And when we look at the big picture, what I believe we're witnessing is that type of consolidation you typically get before a big move. We'll look at that in technical studies through the charts where I'll show you examples. But first, to the price board. Traders, as you can see, the entire precious metals complex is under pressure today. We had a mixed bag in equities, first to gold, down $5.70, $17.29.90. The low on the day was $22.70 and the high $49.20. When we look at spot pricing, that is currently at $17.2250, down $3.29. Platinum lost about $25 in trading, is currently at $813. Palladium had a drop today of $13.70, $1,911.80. And then silver had a pretty dramatic decline, losing about 30 cents at $17.48.5. A lot of that due to dollar strength. The dollar itself was up about 0.3%, and it is currently at 97.42. The rationale for the topic of our opening letter today was really to put current pricing into perspective, because when we consider where we've been over the last 4 years, we've seen a tremendous rise in gold pricing from about $1,000 to about $1,700, a $700 move, and we're only about $200 shy of the all-time high. We can also look at the recent activity because it has really taken off when we consider that back mid-March, and of course this is really when the epidemic became a pandemic, did we see the first dramatic rise in gold, and it really took it from $14.50 up to the high at $17.88. So the fact that we're trading sideways now is definitely, in my opinion, a period of consolidation, and it is a period of consolidation in a very bullish market. Now, why do I make that claim? Well, we have to look at some of the technical indicators. First of all, this is our 50-day moving average. That's in green. That represents the short-term market sentiment of being bullish or bearish. Above it, of course, is bullish. Below it is bearish. Below that is the 200-day moving average. That's the long-term perspective of current pricing. And what you can see right now in terms of the most recent activity in the market, this is where we are fixed with our 50-day moving average, except for some lows that came in and one particular area, and that is this area right here at the beginning of June. Did we see gold pricing actually dip below the 50-day moving average and then quickly recovered? In terms of the 200-day moving average, we really have to go pretty far back in time to see the last moment that it actually traded below that price point, and that occurred really at the end of 2018. And again, that was only for a brief moment. That is this area right here. So for the better part of the last, say, 2 years, this market has remained effectively above these moving averages, except for small incidences in time when it would dip below it and then move back above it. So with that in mind, when we look at current pricing, yes, we are in a consolidation pattern. Yes, we are trading in a narrow and defined range, but that range is still in a bullish demeanor as long as we remain above those key technical indicators. Which brings us to our extremely long-term view of the market. To do that, we have pulled up a candlestick chart that is a 2-week candlestick chart. Every candlestick represents 2 weeks in trading. This is the all-time record top at 1920. And of course, this is the lowest that it hit during the multi-year correction, 1040 to 1045. What we have done is we've created a simple Fibonacci retracement from these 2 points, effectively from this high down to this low, and we can see how the market reacted at different key fib levels. So the first level we want to look at is going to be the 38% retracement. And we can see that we had that period of time between 2016 and call it the end of 2018 where we really had this defined top at about 1380. You can see that there were several attempts that were made to take out that particular price point, and that failed on each and every occasion. Then the market dipped back down to about 1200 here, but that all changed really at the beginning of 2019, and that is marked by this arrow that I'm putting up right now. This is our beginning of 2019 in this candle right here, because aside from a little bit of downside action through the first 2 quarters of the year, we have literally seen it jump from 1250 back up to about 1700, 1788 being the top. When we look at the next level, the 61.8% retracement, we can see that we definitely had some resistance in this area. It took it a little while for it to break through that. In other words, you can see a period of approximately 2 months in which it was unable to take it out, and then it jumped above it. And the reason I bring that up is because when we look at our current activity, at least to me, it is very reminiscent of what we saw back here when the market was hitting a new critical and key level. Now, we can match our tops up from these highs here. They come in at about 1800, and that obviously is a brass ring right now. That's the level that we have to take out. We've not been able to effectively trade and hold above, call it 1730 on a weekly or bi-weekly basis for quite some time. But my sense is that once we break through this area, we have to challenge $1,800 per ounce. And I do believe we will see that by the third or fourth quarter of 2020. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.